Join us now to talk about the retail investor and the impact of the recent jump in interest rates is JJ Kinahan, CEO of IG North America. And JJ, looking at some of your comments, I understand what you're saying because I think you're right. There's been a shift in mentality for retail brokers. It's almost every tick now in the bond market can cause some fluctuations in the stock market. And I was thinking, well, how is that different? Is it really different? We did go through about 500 basis points of increases in a pretty good rally, pretty good bull market. So something has changed recently because the market's having a lot of trouble advancing every time rates go up even a little. What's different?
Yeah, I think what's different, Joe, over the last few weeks is it went from this macro picture based on sort of the Fed meetings and some Fed comments between the meetings to now bonds. The stock market is subservient to the bond market in a way that I don't think it was before. And what I mean by that is we really are moving tick for tick with bonds. It's unbelievable how, whether everyone realizes it or not, over the last couple of weeks, they've become a bond trader. And because that's how the stock market is moving it, the correlation has just increased so significantly over the last few weeks. And I think the other really important thing, and I know you guys have talked about it on the show before, but the fact is, if you're under the age of 45, you probably have not experienced as an investor a rising rate environment. And so I think that's also become very confusing for people. And suddenly they're like, hold on, I have to pay a lot more attention to the daily moves in bonds, if you will, than maybe I did before. And so we are seeing this whole thing of, all assets people are questioning at the moment in terms of, do I really want to hold these, or do I have the risk tolerance to hold these through some perhaps volatile times?
Yeah, the Fed didn't do anything last time. All the moves we've been seeing recently are not really from what the Fed did. I mean, it was weird because while they were going up 75 basis points, the market was fine. Now they haven't really hiked, and yet the market's got. That's what I think is unsettling, maybe to some people too. That it doesn't. They did make comments higher for longer, and the dot plots changed. But they haven't done anything, and the 10-year yield is backed up, and that might be disconcerting. We got about 40 seconds, JJ.
All right. I think your first comment, Joe, is the one that really has people a little bit, and that is the market's finally accepting that the Fed may not do a rate cut. Think about how many times we talked about 6 months ago, perhaps a rate cut in the fall, a rate cut by the end of the year. I think the market is fully starting to accept the fact that we may be higher for longer, as you just said. It may go into well beyond the spring of next year before we see any relief on rates. And now the housing market and everything else has to adjust to this, and because the housing market has not adjusted to where rates are at all, as you guys have talked about before in the show again, in terms of supply versus rates.